Good morning and welcome to the Killik and Co market update. There's been a lot of focus on the US labour market this week because that's one of the main areas the Federal Reserve looks at when it's making decisions about future interest rate policy. If the labour market is looking very strong, then it's probable that the Federal Reserve will leave interest rates at their current high levels. If there are signs of weakness in the labour market, then the Federal Reserve might leave interest rates on hold with a view to lowering them in the future. We've had a couple of bits of data this week that have given quite mixed signals about the US labour market. First up, on Wednesday, we had the JOLTS data, which stands for Job Openings and Labour Turnover Survey. The number of job openings for August was 9.6 million, and that was significantly above expectations. So that led to concerns that firms would compete over job candidates by offering higher salaries. And then these higher salaries would feed into higher inflation, and the Federal Reserve would keep interest rates high. The stock market sold off due to the threat of high interest rates after this data came out. Investors then started selling US government bonds, suggesting that they expect interest rates to be high in the future. When bonds are sold, the prices fall and the yields rise. Here's the yield on the US 10-year. You can see it's approaching 5%, which is a level not seen since before the financial crisis. The next day, we had the ADP employment survey, which shows new hires in the private sector. And this showed a very different picture. Only 89,000 hires were made, which was well below expectations, and that suggested weakness in the labour market. So this means there's now less of a case to keep interest rates high, and as a result, the stock market went up again when this data was published. Given the conflicting implications of these two employment surveys, there's going to be a big focus on the non-farm payrolls data, which comes out on Friday. The current expectation is for this to be 163,000 jobs being added to the economy, and if we get a very different number to that, that could move the market. And also this week, we've had a positive update from Tesco, with the company raising its profit guidance for the full year. It's been a very difficult couple of years for these supermarkets. They've had to be offering value in the middle of this cost of living crisis. They employ huge numbers of people, and there has been a lot of wage inflation. They've also been criticised in the past for squeezing their suppliers too hard, so they've had to be careful not to continue doing that. And finally, they've had to try and keep their shareholders happy. That's a lot of different stakeholders to manage, and so far, Tesco appears to have done a good job of managing those different needs. As you can see by this 5-year chart, the shares responded well to the latest update from Tesco. What's particularly interesting about Tesco is the market share. If we go back 10 years, Tesco had a market share of over 30%. By August 2020, the share had declined to 26.6%, and that was mainly owing to the rise of the discounters such as Aldi and Lidl. More recently, however, Tesco has clawed back some of that share, and it's now at 27.2%, and it's done that by working on its value offerings and its delivery capabilities. And finally this week, it's worth touching on Metro Bank. Shares in Metro are down 98% since its IPO in 2016. The bank has had numerous problems over the years, including a fine from the regulator for errors in its financial reports which misled investors. This week, it has been reported that Metro is trying to raise £600 million via a combination of debt and equity. This situation is a good reminder that the Financial Services Compensation Scheme only covers bank deposits up to a value of £85,000. So those with more cash than that could consider spreading that money across more than one bank, or they could consider alternatives such as UK government bonds, which can be more tax efficient for some. So do give us a call if you'd like to talk about this in more detail. Moving on to have a look at next week, we are expecting results out from LVMH, JP Morgan and United Health. That's it from us. Enjoy the weekend, and we'll see you next Friday.